Hello and welcome to Between the Lines, a podcast that dives deep into the stories redefining APAC's reinsurance landscape. Recorded here in the newsroom of InsuranceAsia News in Hong Kong, I'm Mithun Varkey, Editor-in-Chief for InsuranceAsia News.
Before we get into this week's regular podcast, we had to step back into the studio after the news of the fire in Hong Kong broke out. The latest is that 55 people, including a firefighter, have been killed at the Wang Fut Court housing estate in Hong Kong's Tai Po neighbourhood after the fire broke out on Wednesday. Flames quickly spread to 7 of the 8 blocks in the estate, which had been undergoing renovations since July 2024. About 280 people are still unaccounted for, while 68 people are in hospital, with 16 in critical condition and 25 deemed serious. On Thursday, police arrested 2 directors and an engineering consultant, aged between 52 and 68, from a construction firm for manslaughter. Mithun, you spent the whole day frantically chasing this from an insurance angle. What can you tell us, and who's on the hook for this tragic event?
Yeah, Andrew, there's certainly a tragic event and possibly one of the worst disasters in Hong Kong in recent years. For the insurance industry, this is likely one of the biggest single risk loss events in Hong Kong. So what we know on the insurance angle is that China Taiping, the Hong Kong-based insurer, is the sole carrier for all insurance policies of the housing estate, which means that this will be a pretty significant loss for China Taiping. We also understand that Marsh is the broker for the policy, as ISS East Point, the property's manager, is a Marsh account. From a loss perspective, we know that the property all-risk policy issued by China Taiping has a 2 billion Hong Kong dollar limit, while the constructor's all-risk policy has a limit of 315 million and a $50 million third-party liability limit, and an employee compensation limit of 200 million per event. It's too early to estimate the actual loss, but the industry sources say it'll be upwards of 1.5 billion Hong Kong dollars, which is about 200 million US dollars, which will be a significant loss. And it could be much more because we don't know the constructor's all-risk policy. We don't yet have an estimate of what those losses will be. So it'll be a complicated loss. One of the things that, I didn't write in my story, but one of my sources told me is that there's a real risk that the property was undervalued for insurance purposes. That means apparently what's called an average clause would kick in. Under the average clause, the insurer will only pay for the original sum insured and proportionately. So this would be bad news for the homeowners who will likely not be properly compensated. The point is, there's been a few fire incidents in Hong Kong recently, most notably the China Kem Tower fire last month. There were a few others incidents in the recent weeks, and I think this is something that should be worrying the insurance industry here. In Hong Kong especially, we often are worrying about the nat cats, but man-made losses can be quite large too, and these losses do add up. I think we're far from knowing the actual loss and understanding what are the causes of the event. Loss adjusting will take a while for us to have actual numbers, and that there's an investigation ongoing, so we'll have to watch what happens.
We will, of course, be giving you the updates for this as more of the news develops. Now back to the regular podcast.
And in this episode, we'll discuss the biggest news stories from around the region, including investigations into workplace conduct of ex-Lloyd CEO John Neal and Steadfast CEO Robert Kelly, a wrap-up of the recent NatCat events, and our recent exclusives. We'll also be discussing our future stories. Our special guest today is Rebekah Khew, who's a director at Hong Kong-based marine MGA Vivace Insurance. Rebekah will discuss the booming MGA space in Asia, especially in Hong Kong, and what the opportunities and challenges are for MGAs in the region.
I do agree there are some who are resisting or skeptical of the long-term sustainability of MGAs due to the potential lack of underwriting controls. There's always the fear that MGAs may compromise underwriting discipline and push for volume. So it's very important for capacity providers to implement sufficient, sensible checks or put safeguards in place and partner with responsible MGAs in order to mitigate such risk. So I have to say, not all MGAs are equal.
I'm joined today by the full IN editorial team. I have with me Deputy Editor Andrew Mullen, Senior Correspondent Aidan Gregory, and reporters Joana, Nguyen and Roshan Nambiar. Welcome, everyone.
Thanks a lot, Mithun.
One of the developing stories in the last 2 weeks has been the John Neal saga. John Neal, who was the former CEO of Lloyd's, mid-year he announced that he'll be joining AIG in December. 2 weeks ago, AIG announced to the stock exchanges that they've mutually agreed that John Neal won't be joining AIG. While AIG did not provide any explanation as to why John Neal won't be joining the insurer, subsequent reporting from other publications showed that there was an ongoing investigation by Lloyd's against John Neal over breach of workplace policies. Aidan, can you give us a quick wrap of the whole John Neal saga?
Yes. So once again, the Lloyd's market finds itself, facing questions surrounding, culture and behaviour. In this case, the rapidly evolving news story of the last fortnight, centres around John Neal, former CEO who stepped down earlier this year and was replaced by Patrick Tiernan. The market, was with speculation and chatter when the collapse of his move to AIG was, made public 2 weeks ago. And, it has since been revealed that this Lloyd's investigation centres around, allegations of an inappropriate workplace relationship between John Neal as CEO and a subordinate. Lloyd's, came out and said that, there was this investigation going on in October, and, following the news reports that have emerged recently, they've now reopened this investigation with the support of an external law firm. So it's quite a messy situation. Lloyd's in the statement, confirmed that its initial review in October found that there was, possible historic breaches of policy with respect to one particular matter. Lloyd's didn't go into detail about what exactly that matter was, but all of the reporting surrounding this situation shows that it involves a workplace affair. John Neal himself, actually, this isn't the first time that John Neal has been embroiled in embroiled in a matter like this. He was actually fined by his previous employer, QBE, for not disclosing a workplace relationship, and he left QBE not so long after that happened.
Indeed, I think Lloyd's has quite a lot to answer for, and it's not just Lloyd's. I think for the industry, John Neal is not a standalone case. We had another ongoing investigation, this time in Australia. Andrew, you've been tracking the investigation into Robert Kelly. Can you tell us what's happening at Steadfast?
Yeah, sure. So this is the Steadfast CEO and Managing Director, Robert Kelly. He returned to work last week following the conclusion of an external investigation into a workplace complaint. He had chosen to stand aside on a temporary basis from October the 30th while the investigation was carried out. He was on full pay during the investigation. And at the start of last week, Steadfast confirmed that the external investigation into the workplace complaint had been concluded on a confidential basis. That was all Steadfast said. In comments to other media, Kelly said that he was pleased to be back at work, and he also confirmed his plan to leave his position as CEO at the end of next year, but did offer to continue beyond that in an advisory role. He confirmed that he told the board that he was fully committed to running Steadfast, and this is possible because he has terrific people around him. So that's the latest with Steadfast, and we'll watch this space to see if Robert Kelly follows through with his promise to leave in the next year.
I guess that's supposed to come from the investigation on Robert Kelly and Steadfast. Andrew, while I have you speaking on Australia, it's been quite a stormy few weeks in Australia. Can you give us a wrap-up of the Nat Cat events?
So most recently, the Insurance Council of Australia have declared an insurance catastrophe after severe hailstorm and high winds battered southeastern Queensland on Sunday and Monday. As of Monday, they said there was 16,000 claims lodged across 140 postcodes, just showing how kind of wide this was affected as such a wide area. But this number is expected to rise. Now, this is on top of 28,000 claims from a storm and hail event in northeast Queensland a few weeks ago. So that's, pushing towards 50,000 claims already from those two big events. And then also in Australia, the first cyclone of the season has arrived. Tropical cyclone Fina skirted the top end of Australia, missing Darwin and eventually making landfall on Monday evening. Claims are not expected to be as high due to the area, but it's significant as it's the first cyclone of the season and is the earliest to make landfall in Australia since 2013.
It seems like an early and strong start to the cyclone season. Australia reminds us of the Christmas storms a couple of years ago, so it's likely that we'll see more events in the coming days. Moving on, we had some interesting scoops and exclusive in the past few days. Joana, you had a really interesting story on a new reinsurer starting in Vietnam. What can you tell us?
Right. So I met a couple of reinsurance executives during SRC, and they told me that a new reinsurer called Mapfre Re is set to join the Vietnamese reinsurance market. It will be the third reinsurer after Vina Re and Hanoi Re in the country. So they told me that Mapfre Re is backed by a Vietnamese private firm as well as some domestic banks. Its charter capital is understood to be $30.4 million US. The company is still awaiting a license from Vietnam's insurance regulator. It will be led by Lê Hoài Nam, who was formerly CEO of PVI Re, which is now Hanoi Re, and he was also deputy CEO of national reinsurer Vina Re. So there should be more information about this new player in the future. So I'm getting in touch with my sources to track when there's any new update.
Great, that was a fantastic story, Joana. Aidan, you also had an exclusive on Mapfre Re's India plans. Can you tell us more about the Spanish reinsurer's expansion in the country?
Sure. So Mapfre Re is preparing to join the list of reinsurers that have set up shop in India's Gift City, which is a special economic zone that's been set up by Prime Minister Narendra Modi to attract capital to the Indian market. And the list of insurers and reinsurers that have set up in Gift City already is growing fast. And Mapfre Re has an ambition to grow in Asia, and the Indian market, alongside China, is seen as a central plank of that growth. And currently, they don't have an onshore presence in India. They manage their Indian exposures, from the head office in Madrid. But that looks set to change soon, and it's hoped that they'll be operational in Gift City by the start of India's 1/4 renewals season. Gift City is going to be a big story for Asia's insurance market over the next 12 months. As more and more insurers and reinsurers join the fray.
Yeah, certainly. I think we've already written about a few who have set up, and we have heard of some of the other big players certainly planning to set up office in Gift City. So there'll be a lot more stories coming on that. The other story that we had this week, and we were the first to report, was about Hong Kong's marine war risk insurance pool, which was launched last week. Joana, can you give us the details on the Hong Kong Marine Risk Pool?
Right. The pool's name is Hong Kong Marine War Risk Insurance Pool. So it provides marine war risk insurance for the Asian shipping industry. This initiative was first announced by Hong Kong Chief Executive John Lee in his 2025 policy address. So this pool was developed in collaboration with an NGA called Alliance Risk Transfer as its manager. Founding participants include multiple local insurers, for example, China Taiping Insurance, the People's Insurance Company of China, CMB Winglong Insurance, and China Pacific Insurance, as well as Asia Insurance. So the coverage limit per policy is up to 130 million USD, extending to vessels operating in Greater China as well as Asia. And Hong Kong is the world's fourth largest ship registry, and together with mainland China, shipping powers control the largest fleet globally. So this establishment of the pool will enable Hong Kong to better serve local mainland Chinese as well as Asian shipping clients, strengthening its role in maritime risk management.
Indeed, it was, it was only John Lee had announced earlier this year, and it's pretty quick turnaround on the Marine Risk Pool in Hong Kong. It does seem like Hong Kong's coming back. Certainly the Hong Kong IPO market, which has been going through a rough patch in the last few years, is certainly set to be coming back. Aidan, you had a story on the opportunities that brings to the insurance market.
So you're right, Mithun. Hong Kong's IPO market has had a phenomenal year. Hong Kong is set to finish 2025 as the premier exchange globally for IPOs, and that's a crown that Hong Kong, going back over the last 10 years, the contest of the top IPO exchange was always between New York and Hong Kong. But Hong Kong, went through some quite difficult times in the last 5 years, in the wake of the pandemic. But it's come roaring back this year. It's been mostly fueled by mainland Chinese companies, coming and listing here in Hong Kong. But this creates an opportunity for insurers, because particularly insurers that write D&O business. And I spoke to the head of financial lines at Sompo at SARC earlier this month, and she confirmed that Sompo is looking to do more D&O in Hong Kong, as a result of this capital markets boom that we're seeing and the expansion of the universe of listed companies that Hong Kong's enjoying at the moment.
Yeah, the financial lines market had a prolonged softening, so it's good to see that there is more demand coming, and there's quite a lot of companies that have invested significantly into building out financial lines teams, and the return of the IPOs is good news for them. I've been talking about the softening market. There's certainly, I guess the financial lines had a long period of softening, but the rest of the market seems to be softening as well. So I had a really interesting conversation with Joe Pizer and Terence Williams. Joe Pizer is the global CEO for commercial risk at Aon, and Terence Williams is the Asia Pacific CEO for commercial risk at Aon. Really interesting conversation. There's a few things that stood out for me. One is obviously, we wrote the story. Joe Pizer hints that the softening will bottom out sometime next year. And he doesn't think this is going to be a massive correction because the fundamentals of risk haven't changed. The outcomes are going up. There's geopolitical risk and there are new emerging risks. So he doesn't think there's going to be a prolonged softening like we've seen in the past. The other thing that really interesting, that I found quite interesting from the conversation, was the opportunities that the data center boom is bringing, especially in Asia. I think Joe Pizer said that it's the single biggest opportunity for the industry in recent years. So that'll be quite interesting to see how that plays out. We're already seeing some of the big brokers and insurers building out data centers capabilities. And the final thing and this is quite interesting, the sort of analytics products that Aon's launching. So when they told me in the interview that I was having that they all these really interesting tools that allows risk managers to see where the losses are and exactly what the exposures are. I thought that was quite interesting. What was even better is when I was in Singapore for SRC, I had an opportunity to go to the Aon office and see a live demonstration of these tools. It was quite an interesting tool that they have. They can basically map out if you're a big, let's say you're a big retailer or a factory owner, and you can map out all your factories around the world and what sort of exposures you have in each of those locations and tailor your insurance programs around it. The big brokers obviously have the capabilities to build these things. I'm pretty sure some of Aon's competitors are also building it or already have it, but that will be a big differentiator for the broking business going forward. That was quite an interesting conversation that I had recently. After that, I think speaking about Aon, the other big story we had recently was an interview with Alfonso Valera, who's the CEO for Aon's Reinsurance Solutions. Andrew, can you tell us what Alfonso told us about the reinsurance market?
Yeah, this was a really interesting story we were waiting on in the office for a while. This was from our reporter, Marcus Alcock. He interviewed Alfonso on the sidelines of SIRC, and he told him there was a significant amount of capital entering the reinsurance sector. And in his words, there is a wall of capital that's coming into the reinsurance industry in a big way, not only through the form of cat bonds, which are a record high. It's very strong from him and a very good story to look on the website and see more what Alfonso had to say. But yeah, that was a very strong story, and it did really well for us on the website.
I really like the phrase wall of capital. Roshan, you did a story on the Asia's power sector. What's happening in the market?
Yes, so I got in touch with Leo Fu, the head of Power and Natural Resources Asia at WTW, and Benjamin Chang, the managing director for energy and power and power leader for Marsh Asia. From speaking to them, the main insights I got was that Asia's power sector is changing fast, which is pushing up demand for power insurance. But at the same time, interestingly, the market itself has softened with more capacity, lower rates, and insurers becoming more flexible on terms and product design. But at the same time, the story isn't necessarily just about cheaper cover. Things like renewable and battery storage risks, climate and nat cat events, long equipment lead times, data and talent gap means both insurers and buyers have to get much more technical and creative and use tools like parametric and hybrid structures to really manage the risk.
That was a fantastic story, Roshan. This was a great meeting, guys. We've had a couple of weeks of really good stories. What are we working on in the coming days? Obviously, as we go into Christmas and New Year's, I bet working on our own renewal stories. Apart from that, are there any leads that's keeping you busy? Joana?
Yes, so recently, CHAP Malaysia has submitted an IPO application with its sole shareholder, CHAP IAN International Holdings, proposing to divest 300 million shares or 30% stake in the company. So this IPO would allow CHAP to comply with the Malaysian Central Bank's mandate for foreign insurers to reduce their stakes in their local units. So Bank Negara Malaysia earlier gave foreign insurers until the end of 2023 to either reduce stakes in their local ventures to 70% or contribute to a charitable fund. So the bank said that foreign shareholders accepted the divestment condition when they entered the Malaysian market. So I want to talk to people in Malaysia insurance market to see if there will be similar moves by other international insurers in the country.
I bet there's quite a few stories there. Aidan, what's keeping you busy?
We have a big insurance technology conference in Hong Kong happening next week. It's called InsureTech Insights. There's lots of interesting speakers there, and I'm sure that's going to generate quite a few interesting stories as we cover the panels and the speakers and networking at that conference.
Sure, I think, yeah. Me, Aidan, and Roshan will be at the InsureTech Insights conference, and we hope to catch up with all the speakers and guests at the event. Great. It was a fantastic meeting and quite a lot of interesting stories in the works. Thank you, everyone. Let's get back to work.
Thanks a lot, Mithun.
Our special guest today is Rebekah Khew, who's the APAC Director for Hong Kong-based marine MGA Vivace Insurance Partners. Rebekah is an experienced marine underwriter who has in the past worked at Chubb, Beasley, MS Hamlin, before joining the MGA a couple of years ago. The discussion will focus primarily on the MGA landscape in Asia, as we've seen several new players coming into the market in the recent months, and what that means for the broader market, as well as the challenges and opportunities for aspiring MGA entrepreneurs in the region. Rebekah, welcome to Between the Lines. Thank you for joining us today.
Thank you. Pleasure being here.
Could you tell us a little bit about yourself, Rebekah?
Sure. So it's going to be a long story because I've been in the industry for slightly over 30 years right now. I'm Singaporean and I've worked in Singapore before moving to Hong Kong. I've worked in both local and international companies. Started my underwriting career in OAC, which was part of the OCBC group, now rebrand or renamed Great Eastern. After OAC, I joined AXA Corporate Solutions when they started their first marine operation in Asia, followed by CHAP in Hong Kong. So whilst in CHAP, I was approached by Beasley when they wanted a presence in Asia. After Beasley, it was MS Hamlin to help them set up their new office in Hong Kong. So now at Vivace, my current company, which is an MGA, having worked in big corporations for 3 decades, I thought it was time for a change. So I knew the founder, Philip Bailey, since I was a junior underwriter in Singapore. So his entrepreneur spirit, the sharp vision, the ambition that he has for a new MGA platform really resonated with me. So something clicked, and I just want to take this opportunity also to thank him, for the chance to join him on this journey. Vivace was incorporated in Hong Kong towards the end of 2021. We also have offices in the US. So I joined them 2 years later after the incorporation in December 2023. Now the word Vivace, pronounced the Italian way, it actually refers to a music tempo that's spirited or lively. It's also a term for a slightly sparkling wine, which is nice. So now we are marine specialist MGA, and we have capacity for niche products such as marine war, equipment, freight forwarders liability, and also the mainstream cargo. But something within that is a niche frozen seafood and rejection risk.
Interestingly, do very niche risks, and that's obviously what MGAs bring. So you've been in this MGA world for a few years now. Can you sort of give us an overview of the MGA landscape in Asia?
Sure. Now, MGAs are insurance intermediaries. So they can be an agent or broker that's been granted underwriting authority by the insurers. MGAs actually emerged in early 20th century when the insurers were looking for ways to expand distribution. So it is not a new concept. Today, it is arguably the fastest growing segment in the insurance industry. And in the recent years, we've seen like Hong Kong, Singapore emerging as key players. There's been a surge in a new MGA setup. As far as regulatory regime is concerned, they are still very much in development in Asia. Most regulators in Asia do not recognize the MGA model, and they do not have a dedicated framework to regulate MGAs. But this is beginning to change. Now, a good question on how they compare. A bit challenging to draw a comparison, apple-to-apple comparison between Hong Kong, Singapore, and Labuan because they take different approaches. Hong Kong has been a long-standing mature market for Lloyd's, serving as a dynamic international hub with supportive regulatory environment, while Singapore is focusing on specific market segments with Lloyd's. Now, in Hong Kong, through the Insurance Authority, there's no dedicated framework to regulate MGAs. MGA falls under the General Insurance Intermediary Licensing Regime. In Singapore, the MAS framework is somewhat more implicit or modular. The MGAs are regulated via existing intermediaries, regulations, and insurer responsibilities. So like Hong Kong, there's no special license for MGA. The MGA model in Singapore is operational under MAS oversight and approval, but with the regulatory touch points through existing insurer licensing and intermediary regulation. As for Labuan, the FAS framework or regulatory regime offer a quasi-MGA structure via underwriting managers, given Labuan's role as Malaysia's offshore international business center. So broadly, I guess the main difference from Hong Kong and Singapore is their onshore stringent regime of governing insurers and intermediaries versus Labuan's offshore way of regulating the MGAs.
While you say MGAs are not all that new, but obviously for Asia, I mean, it's quite new for Asia, I mean, as a distribution model. And how do you see sort of risk managers as well as even brokers viewing the MGA market in the region? The MGAs that we have are fairly new. Do you think there is confidence in the market to place risk with MGAs at this point?
You're right. I mean, MGAs in Asia is still fairly new. I mean, in APAC, Australia is the more mature market for MGAs, and they have the highest concentration of MGAs. I think over here in Asia, we've got a mixed basket. There is a growing, a cautious confidence in the MGA model, but it's not uniform across all the markets or lines. In key hubs like Hong Kong or Singapore, MGAs are increasingly seen as business or strategic partners, and their ability to underwrite with delegated authority makes them attractive for specialty lines or for emerging risk. So this is appealing to brokers and risk managers who are looking for a tailored solution or a more flexible solution. Now, the commonly cited strengths of MGAs are their specialization, the local expertise, the speed and technology-driven underwriting. Whilst I do agree there are some who are resisting or skeptical of the long-term sustainability of MGAs due to the potential lack of underwriting controls. There's always the fear that MGAs may compromise underwriting discipline and push for volume. So it's very important for capacity providers to implement sufficient, sensible checks or safeguards, or put safeguards in place and partner with responsible MGAs in order to mitigate such risk. So I have to say, not all MGAs are equal. So consumer confidence, I believe, depends heavily on the MGA's leadership, their expertise, track record, their reputation, capital backing, and internal controls. So the confidence level will tend to be high when the MGA capacity is strong, have a solid track record of stable capacity, strong claims handling, and knowledgeable underwriters who can make decisions quickly. So naturally, more education or explanation is required for the new MGAs.
Well, you did say that MGAs are bringing specialist risk and specialist underwriting expertise. Some of the recent criticism around MGAs have been that, there's quite a few MGAs coming in. There's plenty of capacity available in the market. MGAs are beginning to write more mainstream and plain vanilla risks. How do you see that sort of criticism about MGAs? Do you think MGAs really what they bring is that niche specialty expertise, or do you think there are opportunities for MGAs to compete with the existing markets?
Well, critics may argue that MGAs are now expanding into mainstream or plain vanilla lines when they really should be writing only specialty risk. Once they tread into the mainstream, they seem to, it appears like they are behaving like a distribution arms rather than a specialist underwriting shops. But that's only partially valid, in my opinion. Let's not forget the whole essence of an MGA existence is what they bring to the table. So their differentiation does not hinge entirely on niche products. MGAs can make sense or succeed in the mainstream categories too if they can offer better customer journeys, provide efficient distribution, market access, superior underwriting or tech capabilities, offer specialized data and operational efficiencies, iterate pricing or product design rapidly, or simply by offering better economics. So in other words, cost savings to the carrier. So cost is a critical consideration whether the capacity provider or insurer will consider partnering or backing the MGA. Now, many insurers are looking to MGA as an additional conduit or access to new markets, especially with the with the increasing operational cost and inflation. So insurers are recognizing that they can access additional income via what can be a more cost-effective mode. In addition to that, MGAs can provide carriers with instant infrastructure, including well-managed risk and governance structures, intellectual property in underwriting pricing, and access to underwriting talent. All of these are instant savings for the carriers, given that significant investment is needed to build from scratch. So MGAs can bring profitable business to the carriers for only a fraction of the permanent or long-term overhead involved in employing underwriters in the region, be it niche or mainstream. So niche is helpful and useful, but not mandatory. MGAs do need to be differentiated, though. If an MGA can offer speed, superior economics, expertise, strong data analytics, tech, access, cost savings in a mainstream line, that can be just as valuable as being niche.
You mentioned cost saving a few times. Talking about cost saving, it certainly is. We're seeing a softening market. There's more additional capacity coming in through the MGA route. Existing markets are also deploying more capacity. How do you see the MGAs fit into this sort of softening environment? Is there a concern that there is more capacity coming? We mentioned, you sort of mentioned about MGAs could potentially be volume focused. Some of them, I'm not saying, but some of them could be volume focused. So how do you see that boom in MGAs impacting the broader insurance market in the region?
After 5 years of hard market conditions, global insurance landscape is softening again, unfortunately. Cost of capital has fallen, insurers are making profits, so the new capital is coming in faster than it's being absorbed by the losses, resulting in increased underwriting appetite and reduced premium rates. Brokers are now reporting negative renewal pricing trends across multiple lines. But historically, during the soft market, insurers and reinsurers would reach out to NGAs to drum up business and to make up for soft market conditions. With more players, more capacity, more competition, the short impact is obvious. Influx of MGAs will definitely accelerate the market softness and increase the downward pressure on rates. Question about how long this will last and how deep it will go, no one knows. If the softening persists, I think insurers will be forced to rethink their game plan. So in the medium term, I think the underperforming MGAs could lose the capacity and gradually fade out. But if MGAs are able to stay ahead of the curve, deliver good quality results and provide better underwriting performance with innovation, that MGA will survive irrespective of the soft or hard market.
Interesting. So there's quite a few MGAs that are coming into the market, but not all of them would survive. Only the fittest would survive, is what you're saying.
Definitely. Fittest will survive. I mean, this is the free market dynamics, right? I mean, the market will adjust by itself.
Thank you, Rebekah. That was a fascinating conversation around MGAs, and we'll certainly see more MGAs coming in the near future. Thank you very much for your time. Really enjoyed having this conversation.
Thank you, Mithun, for having me here. Pleasure to be here and talking about this topic, MGA, which is really close to my heart.
That's all from us in this episode of Between the Lines. We'll be back again in 2 weeks. In the meantime, you can connect with us on LinkedIn. Make sure you're subscribed to our daily and weekly newsletters delivered straight to your inbox. And of course, we'd love to hear your feedback on the podcast. Email us at editorial@insuranceasianews.com. I'm Mithun Varkey. Thanks for listening.